Hello, everyone, and welcome. Thank you all for joining us during the Lytham Partners Spring 2022 Investor Conference. My name is Robert Breza, Vice President of Lytham Partners. During this presentation, we welcome in CEO Scott Stewart and CFO Stephen Taylor from IBI Group, ticker symbol IBG on the Toronto Stock Exchange. Today, I've asked the company to briefly run through its live presentation, and then we'll engage in a fireside chat, like a Q&A session. Before we begin, those not familiar with Lytham Partners, it's one of the country's leading investor relations firms with more than 2 decades of corporate access experience. We have built one of the industry's most diverse and effective platforms from connecting small companies with high-quality focused institutional investors, while creating a framework of best practices in all the aspects of investor relations. Today hopefully presents another example of where we can bring value to multiple constituencies. Before we begin, one final item. I want to remind everyone that IBI Group is available for one-on-one meetings later this week. If you have not already signed up, please send me an email at Breza, B-R-E-Z-A, also at the bottom of the screen, at lythampartners.com, L-Y-T-H-A-M, partners.com, and click on the one-on-one meeting request button. With that said, let me now turn the presentation over to Scott Stewart, CEO of IBI Group. Please proceed.
Oh, it's a pleasure, and delighted to be here with you. Let me bring up my slideshow and introduce IBI. We are a technology-driven design firm, and we have been in business for a long time, since 1974 originally. And our theme is about defining the cities of tomorrow. Let me just proceed through the presentation here. So a bit about IBI. We are a global firm. We have some 60 offices in 60 continents. We have some 3,400 staff in those various offices. We see ourselves as we're a world leader in advanced urban environments, both in its built form, the buildings, in the infrastructure that supports the movement and activity within those buildings, as well as technology that then gets layered on top of the urban environments to make them more efficient and safer, more engaging, and more sustainable. The kinds of services we provide include architecture, engineering, planning, technology, and what is important is of note here is that relative to all other A&E firms, we have a very significant intelligence or technology part of IBI. The core business components, and it's a perfect segue in from what I just said, is that we're focused on urban environments. We look to provide a range of services in the urban environments. Our breakout of revenue is intelligence at approximately 18% of the overall revenue. Buildings, predominant part of IBI, it's 50%, and infrastructure at 32%. The thesis that we have, and it's been part of a pivot that we made about 4 years ago to be a technology-driven design firm, is that we want technology to be really drive our growth, in particular into software as a service kinds of platforms, but also it supports our growth in the A&E business because the kinds of conversations and the value proposition that we have when we meet with traditional firms, traditional clients, is very different. And as a result, the conversation tends to focus more on what's the other value proposition, and they hire us because we have this richer, if you will, platform and array of services. We are focused on urban environments, and that's conscious. Urbanization is still a very powerful force globally, and even in established urban environments, established cities, be it Toronto, LA, or London, they are going through a metamorphosis and a complete change for a variety of reasons. So it's a very strong platform of growth for us. And lastly, in terms of the investment thesis for IBI, is the flexibility around our capital allocation. We have a very strong balance sheet, and we have focused on having a significant amount of dry powder to allow us then to make strategic investments in terms of acquiring new firms and moving into new areas. Okay. Also, part of IBI's future is the how intelligence fuels our movement, if you will, our business plan. And this is part of our launch to be a technology-driven design firm. So there are 4 streams to that. The first is about using technology to deliver better results faster So we use a lot of bots, RPAs, robots, if you will, to take the drudgery out of the kind of work that we do, to speed up the quality of user tools to create better quality faster. It improves our margin. It also makes IBI a much more engaging place for people to work, because we are providing a better work environment, and especially for young people who are coming into the organization, who have grown up with platforms like Minecrafters and engaging tools globally. Also, as part of that investment in the right kinds of platforms, it's allowed us to operate internationally as one firm, from India to LA. When we are using the platforms that we developed and the tools that we now apply, it is one team. And as a result, our collaboration has more than doubled in the last, through the period of COVID. The other aspect of being a technology-driven design firm is new revenue streams. We have traditionally been involved in traffic management systems and toll systems and traveler information systems. Well, we're focused on changing those over to a cloud-based application, so we can be more competitive in the marketplace, expand our market share, and also improve margin. But we are also heavily involved in creating and harnessing new technologies, providing new kinds of services in buildings and also in infrastructure. So it changes again, the relationship that we have with our clients, because as part of the SaaS world, we're looking to have recurring revenue, and that's a constant theme around our involvement in the urban environments. Third area is that of disruptive technologies, and certainly there has been virtual reality, augmented reality, design as a service, and then we're seeing more disruption taking place, and it's the metaverse, the Internet 3.0, and blockchain, and other kinds of disruptive technologies. It's imperative that we are on top of those, that we're embedding those into the kinds of things that we do, so we can better inform our clients and better protect our own business. Finally, there's a whole smart city ecosystem. And when we started our pivot, we looked around at what was in the marketplace, and there was fintech and there was medtech, but there was really nothing around smart cities. So we established our own ecosystem in working with various major contractors, power companies, developers, new technology, all about bringing the various parties together so that we can respond more effectively to creating smart cities. So we see intelligence. So a bit of background here further is that under the intelligence area, it accounts for about in 2021, about 80% of our revenue. Or sorry, not 80%, $80 million in revenue. EBITDA, that is in the order of 22%. But of that, approximately $20 million was recurring revenue. And it was delivered through a variety of ways, excuse me, advisory services, where we provide information and guidance to clients on the kind of technology they should adopt. Oftentimes that then leads the client to ask us to provide the solution. So we actually then provide solutions, be it toll systems, traffic management, transit, etc. And in the toll area, as an example, we collect about $1.4 billion a year on behalf of our clients. In the soft SaaS models, we have developed a smart city platform, and we have other new kinds of services out there, like Curb IQ, an asset management platform called Inform, a workplace management system called InSpace, and traveler information systems, where we're now providing services to some 15 states and 8 provinces across Canada. So we're basically covering North America. In the buildings area, it accounts for approximately 50% of our total revenue, as mentioned earlier, and with over $220 million, and an EBITDA that is in the order of 20%. We our work in, it's a very powerful complement to our infrastructure work, and you'll see the slides in the bottom right-hand side. At any given time, we might have over 400 buildings under design or construction. And often these buildings are co-located in and around major transit facilities. So I'll talk later about our infrastructure work. Along one transit corridor, we have over 40 buildings with heights that range up to 80 stories. That certainly is focused in the area of places to live, but also we deal with schools and healthcare. Certainly healthcare has been an important area for us in the UK more recently, and our education practice is very strong, especially in some of the states. And finally, we bring technology into the buildings, and we are now designing and are the lead architect for the Ford Motor Company's new Research Engineering Center. And we were able to win that work because we have this in-depth knowledge of technology in buildings. Finally, but certainly not least, we have infrastructure. And it's all about providing the right kinds of support systems for urban environments. So mobility is at the top of that list, and it can be everything from mass transit, transit station design, LRT work, and we're dealing with some of the largest projects in North America right now with, for example, a $1.4 billion project in Toronto along the Eglinton corridor, but there are a number of others that's listed here in Ontario, Broadway system in Vancouver, and then other major extensions, which are 10-year contracts in Scarborough and the Yonge Street North Subway. And we also work internationally. We're doing a design work on a major LRT program in Tel Aviv. The bit of a corporate snapshot, you see here our share performance over the last year, going back to March 2020. And you see that it's been very strong performance relative to our peers. We have some 37 million outstanding shares and convertible units. So we have a market cap of some 528 million. We have unsecured debt of 46 million. But what's really important about that is that our debt leverage is 0.4. So we have a lot of dry powder to invest in strategic growth, either by way of firms that we would acquire or by way of investing in new products and services. Our backlog, which we're very proud of, is at some 17 months, and it's been maintained at that level for some time, as we have often very long-term contracts, especially in systems areas, as well as some of our major infrastructure projects. We've also instituted a buyback arrangement under NCIB. The bit of information on our growth through 2020, we had revenue of $444 million, adjusted EBITDA of 68 million, and for an adjusted EBITDA margin of 15.3%. And as I mentioned earlier, the debt ratio of 0.4 times EBITDA. You see the split of where the revenue is derived. Canada still is the dominant share, within Canada East it being some 46% of total revenue, Canada West some 19%, and then 25% in the US, 6% in the UK, and 4% in other international offices. Our backlog has grown steadily from 491 million in 2019 to over 623 million now. And you'll see on the right-hand side the curve that shows the net debt ratio. We are certainly focused in the environmental, social, and governance areas. We have a major initiative underway under carbon footprints, and we'll be launching a comprehensive program of not only reducing carbon in how we operate, but also in the design work that we do, introducing also a much greater emphasis on sustainability of the buildings that we design and the infrastructure we design, and also investing in new platforms that give us better information in how to respond to environmental challenges. On the social side, we have a very robust program of diversity and inclusion and promoting females and visible minorities to grow within the organization to help us in terms of robust health and welfare program, and basically also getting back to the community. Under governance, we follow ISO certification. We have a very strong enterprise risk management system, and over 43% of our board is comprised of females. So in summary, what's a few things that are really powerful about IBI. First is our intelligence driving growth, where we have in intelligence EBITDA margins that are over 22%. Our target is to grow that significantly, but also to grow the recurring revenue. Longer term target would be more in the order of 40 million. We want to disrupt the A&E business. It's an area that we want to be at the forefront of, and certainly we're now seeing many A&E firms are starting to say, oh, we have a technology aspect to our business as well. Well, we love being copied, but we were certainly first out of the gates on that. And we see that as a result of the disruption that we have led, in our view, that last year we had revenue growth of over 13% and organic growth of over 7.5%. And it's worth highlighting that during COVID, we grew and we didn't need any support, any material support from government through that period. And that was a real powerful statement on how we have adopted and applied technology in the firm. Our focus on urban environments we see as being vital, and there is a really strong connection between infrastructure, buildings, and then technology to make them safer, more engaging, and sustainable. And we see that's resulted in certainly our backlog where it is now. And then the final point I want to make again is our capital allocation and flexibility, the 0.4 times EBITDA, and a lot of dry powder to be able to support us in strategic acquisitions and growth, in particular in the United States through the Sunbelt area, but also into strategic services supporting urbanization. So that's IBI. Robert, we'd be pleased to answer any questions that you may have.
Yes, great. Thank you, Scott. One question that came in was really looking at the environment when you think about technology. I'm paraphrasing here. Think about technology as it relates to new business versus your existing install base. What would you say from a technology penetration rate are you within your install base, meaning how much more do you have to go to sell back into the engineering group that you've worked with? And then on the new part, I'm paraphrasing again here, versus 2018, now with your focus on this, how much as a percentage would you say of an old deal back in 2018 versus 2022 or 2023 do you expect technology to encompass as a part of a project? If that makes sense. I think what he's trying to get to is if you're selling technology back in 2018 at 10%, is it 20% in 2025?
Well, I should say when we went public in 2004 as an income trust, the intelligence part of our business is actually 25% of the business. But wow, we were a very small firm at that point. Most of the acquisitions that we have made since then has been in the buildings area, more because there was a lot of availability and great choice. We've always had really good margins in the intelligence area, more certainly above 20%, and by times even more than that. Given that the technology platforms are changing and there's much more emphasis on the cloud, and we're really supportive of that for a variety of reasons, we see that the opportunity is for even greater margins going forward. And if you have the right kinds of applications and market share, you can certainly be above 30% in various SaaS applications. And we see that with, for example, our Travel IQ platform. As a percentage of total revenue, our objective is to continue to grow intelligence. But also, what's important is the intelligence side really stimulates the growth in the engineering and architectural areas. So it adds a new capability. I would say what is also really important, though, is by applying technology, we want to be able to not only have a recurring relationship to the assets that we design, we are also wish to move into more of a management function using technology to manage the assets, to support the operations. Again, so enhancing the recurring revenue theme, and with that, we have a target of, as mentioned earlier, getting to something in the order of $80 million a year, or doubling our recurring revenue.
Scott, I think that makes perfect sense. If I could ask a kind of a lead question, I guess, in your response there, from a government perspective, at least my historical view of being an analyst for 20 years, governments don't change. Once they sign that contract for 10 years, when it comes up for renewal, it doesn't change. Is that a fair assessment in your history of looking at things? mean, it would appear to me once you get them locked in, it's kind of there for a while.
Robert, we have never lost a client.
There you go.
When we have installed a system, we have never lost a client, and that goes back 25 plus years, 30 years.
That's great.
And so you're always there then to provide support on the systems, and even more so as a cloud kind of service. But you're also there to provide enhancements when they have a need to modify, expand, or whatever it might be. They're the ones you call.
Absolutely.
And even in certain government situations where there might be a rebid, you also always have a tremendous advantage if you have, if you will, boots on the ground delivering the services now. So, and with our investment in moving the various platforms to the cloud, we now have an even greater advantage in terms of the margins and the ability to respond quickly. We just installed in India, of all places, for a major bank, a traffic management system on 4 major highways in India. And we did it in 4 months, unheard of, because the application sat on the cloud. And we finished the next 3. The target is today. So 7 deployments in a matter of about 7 months, unheard of, with tremendous margins. So that's the direction. And it's about managing the asset more efficiently.
Absolutely. Another question came in around margin/cost, given the large backlog you have with the need to, or appearance of a need to hire additional people, the pressure that might put on margins, but I would assume there's an offset with the advances in technology you're using. Can you walk people through how you're managing the wage pressure, cost, margin part of the business? And maybe that's where Stephen comes in.
Absolutely. Stephen?
So, Rob, there's a number of different ways that we address that. First and foremost, in most of our contracts, we have wage adjustment provisions in the contracts that allow us to charge the increases in comp through into the contract. There are contingency provisions in place on larger fixed price contracts, and we have a big volume of contracts where we just plain get to pass the cost increases through as part of what we're billing our clients. Now, there are other things that we're doing, and these are as much about being able to find good quality staff at lower prices as they are in terms of protecting margins. But we have built an outstanding engineering office in Athens, Greece, that is supporting many of our transit projects. The Greek economy has not rebounded after 2008, 2009, and there is a wealth of talent there that we are putting to use to help us to meet the demand for engineering services here in North America. As well, we are sourcing software technology, software engineers out of India to assist us in that part of the business. And in fact, many of the new technology developments that we're building that benefit IBI across the board, those are actually being built in their entirety in our operations in India. And thirdly, in our buildings practice, we have set up a capacity in Mexico, where once again, the economy is not as robust as it is in North America. There's a lot of great architectural talent in Mexico, and we're tapping into that. We work as one firm worldwide. We share 32% of all the work that we do amongst offices. And so we're using different geographies around the world to balance the margin pressure.
Sure, that flexibility is fantastic, and you want as many levers as you can pull around the world as you can pull. That's great. One question I wanted to dig into here, or the investor wants to dig into, is the digital twin. Maybe Scott, you could talk to people about what digital twin is, what it means, how it helps you sell. That's basically some summarization of what I can take away from this question.
The digital twin is is basically a virtual world representation of the physical environment. Everything that we are designing now to be built, it has a three-dimensional virtual design quality to it. So you can do walkthroughs. It helps you in design. It helps you understand the nature of your design. It avoids conflicts that you might not see until the construction phase. The ultimate digital twin, though, also extends through multiple stages of then the subsequent stages into construction and then ultimately operations. So we start off in the design world with a digital twin, and then it moves over to the contractor, who then adds further details about what's the model number of the pump or valve or escalator or elevator or whatever it might be. So now it's a source of information. And then it moves into the ultimate world where you can actually then integrate into that using IoT kinds of devices to manage the asset. And so we've been big supporters of digital twins and are working. In fact, in certain cases, we're actually creating digital twins of entire development areas, not just the buildings, but the digital twin and the platform from the entire development area. And this includes among other things, a major airport planning effort that's underway in Toronto, where the airport lands are being repurposed for urban uses. And similarly in Athens, Greece, where we've set up all the design standards to create a digital twin for the infrastructure, for the buildings on what was the old Athens airport, a massive amount of land. It leads to more efficiency in construction and ultimately better use and efficiency in the operations of the assets.
That's great. Additional question here was, I'll summarize here again. If we wake up tomorrow, what would we expect from an M&A perspective if we're reading the newspaper? What type of deal would you do? And more importantly, what type of deal wouldn't you do?
Stephen?
Well, our basic thrust on acquisitions is to increase our geographic footprint, largely in the United States, particularly in the Sun Belt region. Our intelligence practice, it relies on our buildings and infrastructure guys as a channel to market for the technologies that we have. So increasing our geographic footprint into additional buildings and infrastructure businesses within the Sun Belt of the United States. And I'm saying down the West Coast, across Texas, across to Florida, and back up to the Carolinas is basically where we're largely looking. We want infrastructure and buildings businesses to bring those on board, so it gets us in front of a broader client base. I mean, obviously, we're looking to buy good businesses that are accretive to IBI. Currently, we're sort of looking for smaller businesses, or what we're experiencing for smaller businesses, EBITDA multiples of 4 to 6, larger businesses. And when we say large, 100 to 150 people would be large for us. We're not looking for 1,500 people at the moment, but we are looking at businesses up to about 150. Larger businesses, the multiple would be in the vicinity of 7 based on what we're seeing at the moment. So that's what we're looking for to utilize our free cash flow and our banking lines on the more traditional side of our business. And what we're looking for in technology are earlier stage subject matter expert companies where they have a technology that we think is great and is applicable and is something that our clients are asking for. And so we would bring them on board, take their technology and operate as a channel to market for them. That could be an outright acquisition, or it could be a portfolio investment like we've made in the businesses Switch and most recently environmental sensors and ESI. That type of investment could take on multiple forms, but we're not really looking to pay 10 times revenue for technology businesses, because we just don't see that would fit culturally with us, and B, that would actually really provide any net benefit or return to our shareholders.
That's great. Great way to say it, I think, in my opinion. One additional question, not surprising. What's your exposure to Europe and Eastern Europe, and has that impacted any of your business today?
Our closest operation to Eastern Europe is in Greece, where we are maintaining, enhancing, and expanding and supporting our toll and traffic management systems on the major motorways. So that's not affected. We don't have any work in the Ukraine or Poland or any of the Eastern European countries. We are also not in Russia. And those are certainly, in the case of Russia, that was a conscious decision that was made a long time ago for a variety of good business reasons. And at the moment, we don't see anything that's impacting either the Middle East or the UK. One of the positives out this maybe there's a lot of tremendous talent in the Ukraine, and
Sure.
And possibly as an interim support to the country and to the people, we are actively, in addition to supporting the Red Cross services in the country, we see there may be an opportunity to retain some significant talent to help us as we manage through the work in our backlog, but help them as well to get back on their feet as they then ultimately look to move back to the country once peace is restored and the country goes through a rebuilding program. So we're not affected negatively, and we're going to see what we can do to contribute and also benefit from being engaged with the great people that are coming out of the country at the moment.
Yeah, I think that's great. If we can take a positive away from anything from that world tragedy, it's, there are people who are going to be needing jobs, and like you said, they're very well educated, highly educated, a lot of engineers in that area of the world.
Yes.
So that's great. One final question is, I guess, more or less related to internal growth versus external growth. It seems fairly balanced from my perspective. So maybe just the general question on how you look at internal growth versus external growth.
Well, let me touch on the internal growth. Certainly, and for reference, we've given guidance that's basically 3% growth organically. That is there is a philosophy within the firm that we are conservative, we understate and over-deliver, and we've demonstrated that over the last 4 years. We are certainly, and with our backlog, we're certainly striving to have stronger organic growth, and we've advised, but we never like to overstate our expectations. We have a very strong backlog. Our buildings group is fully booked right now for the year, especially in North America. So that's very strong. Our intelligence group has been successful in a number of new areas, especially in support and operations contracts. And we continue with the major infrastructure work that we're involved in, especially in the public transit area. So and there's a lot more to be bid on there, and we're involved in various bidding exercises. So we see certainly a strong organic growth that would not be out of line with some of the history that we've had, but as I said, we're very conservative. Stephen, is there anything you want to say on the strategic growth?
Well, I think that we have a internal corporate development group that's very, very busy at the moment. We have a full list of companies that we're talking to about acquisition targets. We will be making some announcements over the next 6-month period as to which of those businesses are coming on board with IBI. And so while we haven't made any commitments as to what sort of revenue levels we might be bringing in by way of acquisition, I would say that please stay tuned. There will be a healthy and significant amount of new revenue streams brought in by way of acquisition. Of strategic acquisitions. We're not just out for buying for the sake of buying, but things that will really help accelerate, get our technology out there into a broader client base.
One comment I wanted to make, Robert, if I may, just one last quick thing, is that what we have noticed in the past year is that there's been a significant, and COVID has brought this on, as well as some of the supply chain issues. We're seeing a tremendous amount of activity in onshoring, reshoring, bringing back chip plants for chipsets. We're seeing Samsung and Intel making huge investments. We're seeing new automotive plants, especially the electric vehicle side. We're seeing battery plants, and we're seeing a much greater emphasis on logistics and supply chains within the country, with source manufacturing and smart manufacturing. We see that as a strategic area of opportunity for us.
Scott, I think that's a great point you make, and I want to just ask maybe a follow-up question for you. So as you think about the world today, and with, let's call it for what it is, people now starting to retract from Asia, or thinking about retracting from Asia, moving back towards North America, either Canada, US, Mexico. It's definitely a trend I think that's going to be in place for the next 10, 20 years, because that stuff doesn't change on a dime. But when you think about that as, the CEO, and you put on your thinking hat late at night on a Saturday after a glass of scotch, I hope, where do you think maybe the percentage of revenue is from Asia, where it is today and where it is tomorrow? What is that kind of basic trend going to do for your revenues? Maybe that's the best way to ask it.
Well, it's still very much in the formative stages,
Sure.
but it's certainly a common undercurrent. I see that what will emerge for us will be a significant growth in our industrial practice, where we have worked for Ford and GM and BMW and Chrysler and others. And so that's one. Two, there'll be much greater emphasis on green and green energy. And so we're doing significant work in the area of bus fleet electrification, school bus electrification, and all of the work around then the charging stations, maintenance facilities. We have over 15 projects in the planning and design phase now. That we see as a very powerful direction. We do see as well, anticipate that there will be a great emphasis to bring battery manufacturing, not just fabrication, but manufacturing into North America. Right now, there's a tremendous dependency on China. China's acquired over 50% of the lithium sources in the Congo. We see that in North America, there's an opportunity to actually be able to do a complete vertical integration from the mining source right through to then the final product going into the vehicle. So we see it certainly being, that is a direction and an opportunity for us. The only qualifier I provide on it, though, is that on the design side, where your services are digital or can be digital,
sure,
there still can be global, because you don't have the supply chain issues. So we can design the airport in Greece with our team globally, and it looks local, and it is fundamentally local, because we're only moving electrons around and we're not moving hard goods around. So a much different supply chain issue.
Sure. No, I think that makes great sense. One kind of follow-up question as you look at the undercurrents here, what would you point to? Are there any other big currents that you're seeing? You mentioned green. Obviously, we have a change in desire for manufacturing locations. I know you've expressed concern, or not. You've expressed the changes that are going on in terms of urbanization, et cetera, et cetera. But when we step back and look at world themes outside of the construction, architectural engineering program, is there anything that really worries you? I think that was kind of the question that the previous guy was trying to go for.
The worry in the urban environment is because there's still being such a demand for housing, and then in turn all of the other social infrastructure that goes with that, schools and healthcare and such, and the physical infrastructure, is fundamentally the cost of delivering that has not benefited from new technology. Construction methods are still the same as they were, and we've not seen any real improvement. Whereas the return on investments in other kinds of technology has been immense, not in construction. And that sort of pressure of demand in urban environments, but with the restriction of costs, we see as a real barrier, where the cost now of housing, as you know, goes up. There's been a limitation around the supply of new housing relative to the demand. And I see that as, in the longer term, and then especially when we see interest rates that are going, could have an impact on urban environments. That would be the concern that we would have. How do we deal with that cost, and how can we take technology into being able to construct more efficiently?
Sure, that makes perfect sense. Speaking from a guy who lives in the Sun Belt and trying to get an architect just to give me a drawing for the remodel of my house, that's 3 months out. So I totally understand the frustration some customers can come with. With that said, I want to wrap up our session today. I want to thank you both, Scott and Stephen. As a reminder, I do want to tell people that our management is still available for one-on-ones later this week. Feel free to send me an email at Breza, BREZA, at Lytham Partners, LYTHAM partners.com, or go to www.lythampartners.com/virtual and click on the one-on-one media request button. With that, thank you and enjoy the conference.
Rob, thank you very much.
Thank you, Rob.
Yeah.